I'd like to give you a little bit of a background on that. If you want more of a detailed explanation, go watch this video from 8 months ago. Everyone is shorting volatility and it's about to blow up. So basically, when you the VIX, it's a measure of volatility on the stock market. It is measured by looking at the price of at-the-money options on SPX. And so when the VIX is low, it's basically the market is pricing in a low chance of volatility because options prices on the market are very cheap. So the implied volatility there is very low. The market consensus is that it won't move much. The price of an option indicates the consensus where the market expects that the underlying might move. So when you look at the money options on the SPX, it's going to that's going to give you the level of the VIX. Short volatility is basically betting against volatility. And so you're saying, hey, volatility is something that naturally bleeds out. It's not something that can just go up in perpetuity. Even after a spike, it just naturally goes down. Every time there's a spike, it goes down. And so there's been a strategy going on for a while now that's gotten huge called shorting volatility. And this is a strategy that comes back over and over and over again, where basically you collect massive amounts of income for what seems like almost no risk, because after a spike, you just start selling volatility and you bet that that volatility will bleed out of the market. And 99 times out of 100, you're right, but it's like playing the house of a lottery. One time you're wrong, you blow up. And that's what's happening right now, or at least that's what it looks like is happening right now. So I've been warning people against shorting volatility for a long time. In fact, I do the opposite, because when you do the opposite, bet for volatility, you're wrong 99 times out of 100, but the one that you're right, you make up far more than you ever lost on all those wrong bets. One example is people have been putting money into funds that do this for them, like SVOL. There's other ones like SVXY and a couple other ones. But SVOL is one that's gotten very popular recently because they're apparently hedged, so that if there is a big spike in volatility that they weren't anticipating, then they don't lose. But take a look at this today. Look at how much they're down. It's like, okay, yeah, you might be hedged, but this is not a winning strategy. Over the long term, this thing still bleeds out. And so even stuff like this, I always recommend against, because they have to take the amount of money and deploy it in the strategy regardless of what the market is telling them. They can't be actively allocating it based on what the market is doing. And so it's just destined to bleed. Versus if you learn how to do it yourself instead of relying on somebody else to do something complicated for you that you don't understand, then you can do this intelligently and you can time your trades more effectively. You can go long volatility when it's low. And on days like today, like literally today, I closed out a long volatility trade that I had, taking some profits off the table. The reason why is because I think that this is a short-term unwind. It looks like, to me at least, that the market is going to rebound from here. And if I'm wrong, don't worry. Later on, I'm going to tell you some plays that you can make that will let you be able to profit from this either way. But it looks like what some of the stocks that are doing after the big sell-off, the volatility spiked here, and it started to come back down. This looks like a short-term unwind of some big money. This doesn't look like the start of a major stock market crash to me. Now, don't get me wrong; it very well could be, and so we're going to get into how to play that just in case I am wrong. But one thing that I never want anybody to do is short volatility. So I would not say, definitely don't sell options like sell calls on the VIX, because that can blow you up and you can owe more money than you even have in your account. I wouldn't even buy puts on the VIX here, because you're likely going to pay way more for them and than they're worth, and you're not going to come out with a chance for a decent profit, especially considering the risk that you lose money on that. And so I also wouldn't just sell all and go to cash. I mean, when I talk to members of Heresy Financial University, that's my private membership group, my coaching group, I never tell them to go all cash. I never tell them to sell everything. I never tell them to, basically we stay invested in the good investments and the good asset classes with the proper asset allocation. Opportunities like this maybe give you an opportunity to rebalance. Maybe one part of your portfolio becomes overweight or underweight. Like gold is holding up very well today. Bitcoin is having a little bit of a sell-off, but the S&P 500 and the other indexes, like they're experiencing some heat here. So this allows you maybe an opportunity to rebalance, number one. But number two, we stay intelligently hedged. So during times when hedging is cheap, you load up on hedging. During times when hedging is expensive, You don't hedge. Like, you don't buy calls on the VIX when the VIX spikes. Like, it's already too late. You're going to pay a lot for it and there's no profit potential. You don't buy puts on the S&P 500 when it's down over 2% in one day. It's too late by that point. You want to get your hedges in place when they're cheap, because that's when the market is saying, hey, there's no possibility of this happening, but there's always a possibility of it happening. So you don't want to do it on days like today when volatility is spiking and everybody's piling in from fear, because the chance is there's going to be a rebound and all of that premium is going to bleed out. So what to do instead? Number one, buy more of your good names. So I'm just using this as an example. I like the company Amazon for the long term. It's not a recommendation. I like the company Amazon for the long term. And on a day like this, look, this is, if I'm not treating this like a trader, I'm treating this like an investor. I'm saying, look, over the long term, let's zoom out a little bit. Over the long term, this is what Amazon does, right? And so when you have drops like this, those are opportunities to buy more shares at discount prices. So if you've got good names and you're treating this thing like, you're a Warren Buffett investor, you're a value investor, you are looking at Mr. Market and saying, thank you, Mr. Market, for the opportunity to buy these long-term investments that are today on sale. The market is giving them to me at a price that is lower than what, from all my research, I can tell is the intrinsic value. And so you look at these as opportunities, not as something to be scared of. The only reason you'd be scared of this is if you have your life savings in something like this, and you are actively selling it because you need to live off of the income from it, and you don't have any hedges in place, then you look at something like this and be scared. But if you're a younger investor at all, if you have any sort of a long-term time horizon here, then sell-offs and market crashes and corrections are something to be appreciated. There's something to be thankful for. There's something something to be taken advantage of. That's the volatility. You want to see that. That gives you the ability. Then when it rebounds later, you have way more shares than if it would have just always only gone up. So that's number one, buying more of good names. Number two is taking profits of hedges and shorts. And so you should have had some hedges and shorts in place, because markets up until a couple of weeks ago were extremely overvalued and just going up, and hedging was very, very cheap. And so having some puts on certain names that looked most overvalued, having some calls on VIX, having some, even just some way out of the money puts on SPY or something like that. If you have any of those in place, then days like this is like, hey, like, we can take some profits off the table on those. Now I've got some dry powder to plunge back into some names that are good, or maybe I just keep that cash on the sidelines, if I need it, expecting more of a drop, something like that. So days like this, when you have big, unreasonable drops, that's when you take some profits from your hedges. So that's number two. Now, number three is, what if I'm wrong about this and you're thinking, okay, well, this actually looks like this could be the start of something. Like when we go back to, let's say this looks like the start of, 2022 to you, and you're thinking, okay, yeah, there's a big drop here and we're headed a lot lower. That's very, very possible. And I'm not saying that it's not possible. But one thing you'll notice is you get the big drops and you get a big bounce, and you get a bigger drop, then you get a big bounce, and you get a bigger drop, then you get a big bounce, and a bigger drop, then a big bounce, and a bigger drop. That's what always happens here. If we take a look what happened in 2020, when the market crashed within 1 month, the market crashed, what was that, like 30% from top to bottom, 35%. You have big drop and then a rebound, then you have a drop, bounce, drop, bounce, drop, bounce, drop. And so you always have opportunities to take advantage of the drop on a bounce. You don't want to try and pile into puts or pile into shorts or pile into calls on the VIX on the day in which it's happening, because that's what all the money is doing. And so you're going to be paying a lot for that, which means when you pay a lot for something, you reduce your profit potential and you increase your loss potential. You want to do it on a bounce, because then the price is a lot lower, because the market is saying, oh, well, the carnage is done. And so the money bleeds out of it. The premium drops like crazy.